the best of Money Matters. Market View on Money FM 89.3.
You're listening to Money FM 89.3, and it's now time for Market View, where we take a look at how the Singapore stock market closed for the day, the biggest movers, sectors, and companies to watch to help you better position your portfolios. I'm Alexandra Parada. The SCI closed up at 0.1% at 3,860 points. Looking at the local front, Sinarmas Land saw a slight uptick after a response to claims about its privatization offer, while Frasers Hospitality Trust reported a 6% drop in its distribution per stapled security. Investors are closely watching Apple's return to the bond market with a $4.5 billion issuance, its first in 2 years, as they weigh the potential implications for the company's capital strategy. Meanwhile, Hong Kong's intervention in the foreign exchange market and the potential impact decision to step down as Berkshire Hathaway CEO are also stirring market sentiment. Now, for more market moves and views, joining us today is Dan Chang, investment specialist and trading representative at PhillipCapital. Hi, Dan. Welcome to the show.
Hi, Alex. Happy Tuesday.
Happy Tuesday as well, Dan. Okay, Dan. So the SCI opened at 3,861 today. So what do you think moved markets today? Any movers that surprised you?
Well, it seems like we pick up the week right where we left off last week, trading in a very tight range. I think last week, right, the SCI moved sideways, likely sidelined by, the general election. And, of course, the Labor Day public holiday that have clipped some of the trading enthusiasm. And fast forward to today, right, it seems like it's deja vu again because, as you mentioned, the STI opened at 3,861 and we actually closed at 3,860. Mm-hmm. So the index was once again boxed in within this tight range, probably by global jitters with, Donald Trump stirring the tariff pot. And, of course, there's a sharp dip in US dollars that have kept investors cautious. And as for surprise move, right, I would have to say is Sheng Siong. It was up 2.8% today. I mean, the company has recently highlighted some expansion plan in Singapore and potentially China. However, it's often seen as a slow-moving, a boring and defensive stock. So seeing that 2.8% rise today definitely is one of the highlight of the day.
I see. Now, Sinarmas Land saw a slight uptick in its share price on Monday, despite claims that its privatization offer is undervalued. And the IFA, PhillipCapital, has defended its valuation range of 35 cents to 36 cents per share. Now, what's your take on how investors are reacting to this offer? And do you think there's room for the price to go higher, or is the offer likely to stand as it is?
Well, just for context, right, the privatization offer is at 31 cents per share. And interestingly, right, we have seen Sinarmas Land share price trading above that 31 cent level for the past few weeks. Mm-hmm. We suggest that the market may be cautiously optimistic or at least hopeful that a revised offer could come true. Mm-hmm. Now, whether that actually happened is actually another matter because, the company financial position and recent performance might have limited its ability to raise the bid. So it's a bit of a balancing act there. As for whether there are room for the price to go higher, well, technically, yes, especially given the wide gap between the offer price and the reported NAV. Okay. However, we need to take note that the controlling shareholder already hold a significant stake. So unless there are very strong pushback from minority shareholders or some institutional or regulatory pressure, I think the current offer might just stand as is what it is now.
Now, Frasers Hospitality Trust reported a 6% dip in distribution per stapled security due to lower net property income and higher finance costs. Now, with the distribution being paid on June 27, how do you see the market reacting to this update? Do you think investors will continue to hold on, or should they be concerned about the financial health of the trust?
Well, as you mentioned, right, the 6% drop in DPS is actually due to two things. Mm-hmm. Number one, the lower NPI, which was impacted by cost pressure like higher property tax and utilities. And second, higher financial costs, which can be arise from refinancing and elevated interest rates. Now, while the drop in this distribution, right, might sound concerning at first glance, I think it's important to look at broader picture. Mm-hmm. The trust top line the revenue, right, the gross revenue, remain relatively stable, and the additional new income sources like the Koto no Hano in Japan have actually strengthened their revenue base. So I don't really see this as a red flag on their financial health. In fact, on the capital management side, right, their gearing remain very healthy at 34.8%, and they have been proactively refinancing and managing their debt. So for, usually people who buy into REITs are income-focused. So for income-focused investors, I think the lower distribution isn't ideal, but it's not necessarily a reason to really panic. It really comes down to, the individual investment goals. If one is in the long term and comfortable with some short-term volatility, right, I think the trust you offer some exposure to global hospitality recovery.
Now, still in Asia, Hong Kong's monetary authorities have spent a record 60.5 billion Hong Kong dollars to defend its currency peg. Now, what does this signal to investors about the stability of the Hong Kong dollar? And should they be concerned about potential devaluation or further interventions?
Yes, actually, as you mentioned, I think the headline sounds a bit dramatic, but it's actually part of how the system is designed to work. So the Hong Kong dollar, right, is actually being pegged to the US dollar since 1983. So what the Hong Kong Monetary Authority, the HKMA, do was that they are actively managing this peg within a tight trading band. So what we are seeing now is actually the Hong Kong Monetary Authority stepping in because the Hong Kong dollar has been touching the weaker end of that band, mostly due to interest rate differentials. And this intervention, right, helped to keep the peg intact by absorbing those excess Hong Kong dollars from the system. And should investors worry? I think in the near term, maybe not. I mean, the Hong Kong Monetary Authority has a deep reserve and a very strong track record of defending the peg. In the near term, I don't see a devaluation is on the card yet. But longer term, I think if there's a persistent capital outflow and economic challenges in Hong Kong, that might possibly keep the pressure on. So that's something that investors may want to take into consideration.
Now, turning to Apple's $4.5 billion bond offering, it has sparked considerable attention given that this is Apple's first bond issuance in 2 years. What do you think drove this move?
Well, I would like to think that, this US $4.5 billion bond move is more like smart housekeeping. With debt maturing and a record US $110 billion buyback on the way, right, they are actually locking in funding at a decent rate before the credit window tightens. So, in my opinion, I don't think it's a sign of trouble. It's just Apple doing what they are doing best, managing their cash wisely.
Now, Apple's debt sales is being widely seen as a strategic move to repurchase stock and repay maturing debt. Now, how does this affect the company's future prospects in terms of growth versus risk? Do you think investors should view this as a bullish or bearish signal for Apple stocks?
To me, right, I think this Apple debt sales is less about survival, but more about strategies. So by raising funds to buy back shares and roll over maturing debt, right, Apple is essentially signaling confidence in its long-term value. You can take it that it's a way to reward shareholders without dipping too much into his cash pile. And for investors, right, this lean more to the bullish side than the bearish side because it shows financial discipline, strong cash flow, and a commitment to boost shareholder value. But as always, right, I mean, we can't just look at one side of the picture. It's worth, balancing that optimism with close attention to macro risks, like what we are seeing now, Trump tariffs and things like that. So the impact on the business side of Apple could sway investors' view of the stock as well.
Now, Berkshire Hathaway's stock saw a 5% dip after the announcement of Greg Abel as the new CEO. Do you think this is just a reaction to Buffett's retirement, or could there be concerns about the future direction of the company without its iconic leader at the helm? What should investors make out of this?
Well, I think the dip reflects some understandable nerve around Mr. Warren Buffett's retirement. I mean, he has been the face and the brain of the company for decades. So any leadership change naturally will raise questions. With all respect, the successor, Greg Abel, he is a very well regarded, but it is only natural for investors to wonder, how the company will evolve without, Buffett's iconic influence.
Mm-hmm.
And I think it's important to remember that, the whole Berkshire's strength lies in its decentralized structure and very diverse portfolio. So I think while there may be some short-term jitters, I think the company long-term fundamentals and management should reassure investors.
Mm-hmm.
So for now, I would suggest holding steady and watching how the incoming CEO will lead going forward.
Mm-hmm. Now, Dan, the Fed will be holding its policy meeting on Wednesday. And while rates are expected to remain unchanged, there's growing uncertainty given the impact of Trump's tariffs. Do you think investors should be bracing for any surprises for the upcoming meeting, given the ongoing uncertainty from tariffs and mixed signals in the economic data?
Yes. So with the Fed meeting coming up, the expectation is that rates will remain unchanged. But you are absolutely right. I think there is a lot of uncertainty around it now. The tariff from Trump, right, if I can call it a wild card, creating a mix of economic signals that can certainly affect Fed decision making. I think, the data has been somewhat mixed, right? The Federal Reserve has been generally cautious, so I won't be surprised if they maintain a wait-and-see stance. But investors should definitely stay alert for any comments or hints about future policy movement, especially in their post-meeting press statement. And in this kind of environment, I think it's always good to prepare for potential surprise, especially if, the Federal just shift its language on risk.
Yeah. Okay, anything else that caught your attention? And what else is on your radar in the coming days ahead?
Well, there are quite a few things. So on local front, right, all eyes will be on the banks earning this week. UOB, DBS, and OCBC will be releasing their result before market opens tomorrow, Thursday, and Friday, respectively. It's very rare that three banks are, reporting their result on 3 consecutive days.
Yes.
So there's a lot of things to unpack for the rest of the week. And this earning will likely to be closely watched, especially for any outlook signals amidst this ongoing speculation about, the interest rate movement. And looking beyond Singapore, right, I think in China, they are releasing the April trade data on Friday. I think that will give us further insight on how the recovery story in China is progressing.
Well, thank you so much for joining us today, Dan.
Thank you, Alex.
That was Dan Chang, investment specialist and trading representative at PhillipCapital. This has been Market View on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.